Welcome to the deep dive. Today, we are plunging headfirst into the latest analysis of NVIDIA's Q1 fiscal year 2026 earnings report.
Yeah, it's quite the report. We've got a really detailed breakdown here.
Exactly, straight from the source, all about a company that's, well, undeniably at the very core of this whole AI boom. So our mission today, basically, take this analysis, cut through the noise, pull out the absolute most important insights for you.
And figure out what these numbers, these details really tell us about NVIDIA's performance, and the AI market right now.
And we're sticking strictly to the information provided in this analysis.
Right. No outside speculation, just what the source says.
So whether you're keeping a close eye on the AI market, maybe tracking technology stocks, or just want to get a handle on what's driving one of the world's biggest tech players, this deep dive into the recent results, well, it's designed to give you a shortcut to being well-informed.
Okay, let's do it. Let's set the scene with the headline numbers for Q1 FY26. That's the quarter ending in April 2025.
Right. The big one is revenue. Okay, let's unpack this. NVIDIA reported record revenue for the quarter, $44.1 billion.
Just massive. The analysis calls it a testament to the unabating demand for its artificial intelligence infrastructure. I mean, that says it all, really.
And on the profit side, they reported GAAP EPS of $0.76 and non-GAAP EPS of $0.21.
Okay, but hold on. Right away, before we even get into how those numbers stack up against expectations, we have to talk about the major factor that hit their profitability.
The China export controls.
Exactly. The new U.S. rules, specifically for their H20 chips that were, well, meant for China, the source is really clear. This directly led to a substantial $4.5 billion inventory charge.
Wow, in this single quarter.
Yeah. So while revenue was, through the roof, that geopolitical reality put a pretty big dent in the reported profit right off the bat.
Okay, so here's where it gets really interesting, comparing what they reported to what analysts were actually expecting. That $44.1 billion revenue figure, it was actually a significant beat. Analysts were thinking maybe, $43.0 billion to $43.38 billion, somewhere in there.
Right. And it even beat NVIDIA's own guidance, which was $43.0 billion plus or minus 2%. So, yeah, revenue performance, stronger than almost anyone anticipated.
Okay, but the profit side, the reported non-GAAP EPS of 81 cents, that actually missed the consensus, right? Analysts were expecting around 0.88 cents.
Correct. But, and this is the key point the source makes, this miss is directly because of that $4.5 billion H20 charge we just talked about. It's not like the core business stumbled.
Ah, okay. So what does this tell us about the sort of underlying health of the business?
Well, crucially, if you look at the adjusted non-GAAP EPS, basically, taking out that $4.5 billion charge, the number jumps up to 96 cents.
96 adjusted? Okay.
And that figure, 96 cents, comfortably surpassed those same analyst estimates of around 80 cents.
So it gives you a much clearer perspective on the company's underlying operational profitability, as the analysis puts it.
Exactly. It really highlights that the core business, stripping out that specific geopolitical hit, actually performed even better than expected.
Got it. Okay, what about the growth trajectory?
Well, the $44.1 billion revenue, that's a massive 69% increase year over year, YoY, and a solid 12% bump quarter over quarter, QoQ.
69% YoY is still huge, even if it's a slight dip from the, 78% in Q4?
Yeah, a slight moderation, but like the analysis says, still exceptionally strong expansion for a company this size. It's incredible, really.
And the non-GAAP EPS growth tells a similar kind of split story.
Sort of. The reported 0.81 cents is up 33% YoY, which is good, but it's down 9% QoQ.
And again, that sequential drop is just because of the H20 charge.
Precisely. If you strip out that H20 impact, the adjusted non-GAAP EPS, that $0.96 figure, is up a stunning 57% year over year.
Wow, 57% YoY adjusted.
And up 8% quarter over quarter. So that really shows the sustained underlying earnings expansion that's powering the rest of the business.
And the analysis gives us some pretty sharp numbers to quantify that H20 impact, doesn't it?
It does. The inventory charge was exactly $4.5 billion. And get this, before the new rules kicked in, H20 sales had already hit $4.6 billion in Q1 alone.
$4.6 billion already sold.
Okay. And on top of that, NVIDIA couldn't ship an additional $2.5 billion of H20 revenue that was planned for Q1. Just couldn't ship it because of the restrictions.
Oof. That really drives home the immediate financial hit from this geopolitical situation.
No question. Okay, moving on. Let's get into what management was highlighting and the specific drivers behind this quarter's performance.
Right. What was the narrative from leadership? Jensen Huang.
Well, the narrative from the leaders, especially CEO Jensen Huang, seemed, confidently bullish on their core business, even while navigating these headwinds.
They strongly emphasized their confidence in the company's AI leadership, didn't they? And talked a lot about the potential of the new Blackwell architecture.
They absolutely did.
Yeah.
Jensen Huang is quoted saying their breakthrough Blackwell NVL72 AI supercomputer is now in full-scale production.
Full production already.
Yep. And he added that global demand for NVIDIA's AI infrastructure is incredibly strong. So they're clearly positioning Blackwell as a pivotal driver for future growth.
Makes sense. And the analysis mentioned the CFO, Colette Kress. Her commentary would probably focus on managing that H20 charge and margin recovery.
That's what the source suggests, yeah. Dealing with the fallout and getting margins back on track.
Okay, what about specific achievements they called out?
Well, the big one was Blackwell being in full-scale production and, crucially, available on major cloud platforms. We're talking AWS, Google Cloud, Microsoft Azure, Oracle Cloud.
So the big players have access now.
Right. And Blackwell's already showing what it can do. The source mentions it's setting MLPerf inference records, delivering up to 30x higher throughput than previous generation.
30 times.
Pretty impressive. They also touched on other things like building factories in the U.S., new products like Blackwell Ultra and Dynamo, strategic partnerships, Alphabet, Google, Oracle, GM.
Interesting.
Yeah, and also seeing their Omniverse platform getting integrated by major industrial software companies.
Okay, so pulling it all together, what were the main things actually driving the performance in Q1? Let's start with the positives.
Okay, positive drivers. Number one, undeniably, was just insatiable AI demand. The analysis calls it relentless global demand for AI training and inference.
And it's not just the cloud giants anymore.
No, that's key. It's stemming from the cloud service providers, yes, but also consumer internet companies, traditional enterprises. And this seems to be growing. Enterprise customers and sovereign AI initiatives.
Sovereign AI nations building their own AI? That's a fascinating angle.
It really is. A whole new category of massive customer, potentially. The second big positive was the successful Blackwell architecture launch.
The timing worked out well, despite the other issues.
Yeah, seems like it. The source points to a successful initial ramp-up, strong market interest. It even mentions Blackwell pulling in billions of dollars in sales in its first quarter.
Billions already for a brand new platform. Wow.
And the third positive driver the analysis highlights is actually strength in the gaming segment.
Gaming. Okay, tell me more.
Yeah, it achieved record revenue, showing renewed vigor. We can dig into the details later, but it's an interesting point.
Definitely. Okay, now for the negative drivers impacting the quarter.
Well, the single biggest one, no surprise, was the H20 export controls to China.
We keep coming back to that $4.5 billion charge.
Yep. Directly linked to diminished demand following new U.S. export licensing requirements announced on April 9th, 2025. And just to hammer it home, $4.6 billion in H20 sales before the rules changed, $2.5 billion more they couldn't ship because of the rules.
A direct consequence of the geopolitical restrictions, as the source says. Crystal clear.
Yeah, and the other factor mentioned on the negative side, though probably smaller, was the initial costs tied to the Blackwell ramp-up.
Right. Analysts expected that scaling up production for something new and complex would cost more upfront.
Exactly, which would temporarily impact gross margins. That was anticipated.
So, thinking about how management communicated all this, what was the strategy?
Well, it seems like they aim to be, very confidently bullish about the big picture, AI's future, Blackwell's potential, while being quite direct and realistic about the specific hit from the China situation.
Sort of acknowledging the hit, but emphasizing the underlying strength.
Precisely. By really highlighting Blackwell's capabilities, its availability on all the major clouds, its performance, they provided a strong counter-narrative to the H20 problem. It felt like they were aiming to reassure investors about the core business trajectory outside of China.
Makes sense. Okay, let's shift gears now and look ahead. What did NVIDIA guide for the next quarter, Q2 FY26?
Okay, Q2 outlook. They projected revenue to be $45.0 billion, plus or minus 2%.
$45 billion, okay.
BT. And here's where you really need to pay attention to the details again. The company explicitly stated this outlook incorporates an anticipated loss in H20 revenue of approximately $8.0 billion.
$8 billion, embedded in that $45 billion guidance.
Exactly. $8 billion gone due to restrictions. This is absolutely crucial context. The analysis points out that when you mentally subtract that loss, or rather add it back to see the underlying picture, it reveals a significantly more robust growth trajectory for the remainder of NVIDIA's business.
So the non-H20 part of the business is expected to grow quite strongly quarter over quarter, even if the headline guidance number looks tempered by that $8 billion loss.
That's the takeaway, yeah. The source even calculates the implied core sequential growth, showing very strong momentum that's kind of hidden by that massive H20 impact number.
What about profitability guidance for Q2?
Margins.
They guided for non-GAAP gross margin of 72.0%, plus or minus 50 basis points.
72%. That's a big jump from the reported 61% in Q1.
A huge jump. The analysis calls it a substantial improvement, and it's even higher than the Q1 margin, excluding the H20 charge, which was 71.3%.
So what does that signal? It's a strong signal, according to the analysis, that the most acute financial impact of the H20 inventory write-down is largely contained within Q1. Basically, they took the big hit already.
And they're expecting margins to recover quickly.
And improve further. They didn't stop there. They also mentioned they're continuing to work toward achieving gross margins in the mid-70% range late this year.
Mid-70s. Okay, that signals real confidence in Blackwell's profitability as it ramps up.
Definitely. On the spending side, operating expenses are projected around $4 billion non-GAAP for Q2.
Yeah.
And they guided for mid-30% range growth in OpEx for the full fiscal year.
So still investing heavily.
Oh, yeah. Continued significant investment, the source says, mainly in R&D for Blackwell and whatever comes next, plus market expansion. Got to keep that edge.
So how did that Q2 guidance stack up against what analysts were expecting before the earnings, the $45 billion revenue number?
That $45.0 billion forecast was actually slightly below the pre-earnings analyst consensus, which was hovering around maybe $45.8 billion to $45.9 billion.
But again, context is everything.
Absolutely. You have to remember that guidance includes that massive $8.0 billion H20 loss. Analysts probably hadn't fully modeled that specific quantum of impact beforehand. So the underlying guidance for the rest of the business looks quite strong when you see it that way.
So what does all this guidance tell us about management's confidence level?
Well, based on the numbers they put out, their confidence in the core business outside those H20 restrictions seems pretty high.
The guidance assumes a lot continues to go right, though.
It does. It implies they expect continued robust demand globally, an accelerating Blackwell ramp, stability in other segments like gaming, and effective supply chain management, which is always critical. They basically quantified a huge headwind, but the forecast for everything else suggests they feel very good about where things are headed.
Okay, let's dive deeper now into the individual business segments. Unsurprisingly, data center is the main story. Pulled in $39.1 billion in Q1.
Yeah, that number's just staggering. It made up roughly 89% of NVIDIA's total revenue for the quarter.
89%. Wow, that really shows the transformation.
Absolutely. Growth was a massive 73% year over year and still a strong 10% quarter over quarter. Even at this size, that's sustained massive expansion.
What were the specific drivers within data center? Still Hopper?
Continued strong demand for Hopper, yes, that's been the workhorse for generative AI. But critically, the analysis also points to the initial shipments and robust demand for the new Blackwell platform.
So Blackwell is already contributing meaningfully.
Seems so. And it reiterates that demand is broadening significantly. Not just the biggest cloud providers, but also consumer internet companies, traditional enterprises, those sovereign AI initiatives we talked about.
Right.
And even customers in automotive and healthcare getting into the mix.
Okay, moving to gaming. The source highlighted record performance here.
Totally. Gaming revenue hit a record $3.8 billion in Q1. That's up an impressive 48% just from the last quarter, QOQ, and 42% year over year.
That's a big rebound.
Yeah, signals significant rebound and robust demand in what's really NVIDIA's foundational market.
And why is that strength in gaming still interesting for you, the listener? Why does it matter alongside the huge data center numbers?
Well, it's where NVIDIA built its brand, its huge user base. The fact that it's still growing this strongly, hitting records, shows it's still a vital contributor. It hasn't just faded away in the AI era.
It shows the core is healthy.
Exactly. And the analysis mentions things like the NVIDIA RTX Remix platform. Apparently, over 2 million gamers have adopted that, and the Half-Life 2 RTX demo. These point to the ecosystem being healthy beyond just selling cards.
Right. It's not just about hardware sales.
Though the analysis does note that while new Blackwell-based gaming GPUs were announced, their impact on Q1 revenue was likely limited. Too early.
Gotcha. Okay, professional visualization.
That segment brought in $509 million. Basically flat quarter over quarter, but solid 19% year over year growth.
What's the story there?
The analysis points to new Blackwell-based products for workstations like RTX PRO Blackwell and personal AI supercomputers, DGX Spark and Station. And also, the integration of their Omniverse platform by major industrial software providers. That seems key for future growth, especially as NVIDIA pushes into industrial digitalization and physical AI.
Physical AI. Interesting term. Okay. And automotive and robotics, still strong YoY growth.
Yeah, very strong. Revenue was $567 million. That was actually down a tiny bit, 1% from the previous quarter, but up a really strong 72% year over year.
72% YoY.
Yeah, the analysis sees this as indicating increasing penetration and what's definitely a long-term strategic play for them.
And the GM partnership was a key development mentioned.
Absolutely. Collaborating with General Motors on next-gen vehicles, future factories, robots, leveraging NVIDIA platforms like Omniverse, Cosmos, Drive AGX.
Cosmos.
Yeah, they also recently released new Cosmos World Foundation models. Think of them as building blocks for simulating complex real-world environments, which is crucial for training robots and autonomous systems.
Okay, so the GM deal is like a validation of their whole platform approach in automotive and robotics.
The source highlights it as crucial validation, yes. The analysis frames this whole segment as a long-term strategic play gaining significant traction. It even calls it an emerging strong third pillar of growth for the company.
Third pillar after data center and gaming. Interesting. Okay, let's look behind the scenes. Profitability, financial health. We touched on gross margin, but let's recap.
Right, so the reported non-GAAP gross margin was 61.0%, hit hard by that $4.5 billion H20 charge. We know that.
But the underlying margin was much better.
Yeah, excluding the charge, the Q1 non-GAAP gross margin was 71.3%. Pretty healthy.
And looking ahead, they guided Q2 to 72.0%, targeting mid-70s later in the year.
Exactly. Which, as the analysis notes, signals strong confidence in Blackwell's profitability and suggests the worst margin hit from H20 is already behind them, contained in Q1.
And what about their spending, their investments?
Operating expenses, they're guiding to about $4 billion non-GAAP in Q2, and I expect OpEx to grow in the mid-30% range for the full fiscal year.
Still spending big to stay ahead.
Oh yeah. The analysis calls it substantial investment directed towards R&D Blackwell, future chips, and market expansion efforts. It's what you have to do in this market.
Makes sense. The source didn't give detailed cash flow or balance sheet figures in these snippets, right?
Not in detail, no.
Yeah.
But based on historical performance and the sheer scale of the business, you'd expect substantial cash flow generation, probably alongside higher spending on things like building those new U.S. factories they announced.
Okay, final section. Let's put NVIDIA in the broader context. Competition risks, opportunities, strictly based on this analysis. How did key competitors look recently based on the summaries provided?
Right, so based only on the summaries here, AMD, for their Q1 2025, reported $7.4 billion in revenue, with 7.96 non-GAAP EPS. Their data center segment did $3.7 billion, up 57% YoY. The source also notes AMD is navigating export controls too.
Okay, $3.7 billion data center for AMD compared to NVIDIA's $39.1 billion this quarter.
Yeah, the analysis points out AMD's scale, even in data center, is significantly smaller than NVIDIA's data center segment alone. Big difference.
And Intel.
Intel, Q1 2025, $12.7 billion revenue, flat YoY, 17-cent non-GAAP EPS. They launched their new Xeon 6 chips, mentioned some AI improvement.
But still developing their AI story.
That's how the analysis frames it. Intel's AI data center story is still in a developmental phase relative to NVIDIA's established leadership. Again, purely on these numbers, NVIDIA's Q1 data center revenue just dwarfs both in this key market right now.
And the analysis mentions NVIDIA's full stack advantage as a competitive moat. Chips, systems, software, ecosystem.
Yeah, citing an analyst view, that integrated approach is seen as a key differentiator.
Okay, what about broader industry trends, tailwinds and headwinds?
Well, the biggest tailwind is just the sheer strength of AI chip demand. The whole semiconductor market was up nearly 19% YoY in Q1 2025, and the generative AI chip market alone is forecast to be over $150 billion in 2025.
So a rising tide lifting NVIDIA's boat significantly.
Absolutely, it's a powerful secular tailwind. On the challenge side, supply chain and advanced packaging constraints are still a thing. Managing that complex manufacturing is critical.
And the geopolitical tensions we've discussed, U.S.-China specifically.
That remains a major factor.
Yeah.
But on the opportunity side of trends, there's that increasing sovereign AI investment by nations worldwide. That's noted as opening up potentially huge new customer opportunities.
Right. Okay, let's get specific on the risks outlined in the analysis.
Top of the list, China export restrictions. called the most prominent risk. We know the numbers. $2.5 billion unshipped Q1 revenue, the $8 billion loss baked into Q2 guidance, the $4.5 billion Q1 write-off.
And the source mentioned Jensen Huang's reported concern about potentially losing a huge market there?
Yeah, reportedly concerned about forfeiting a potential $50 billion market opportunity to domestic Chinese rivals if they're locked out long-term. It's a big deal.
What other risks?
Blackwell execution risk. Just successfully managing the supply chain, the yields, the costs for such a highly complex new platform launch at scale. The analysis notes prior reported technical issues seem resolved, but execution remains critical.
Competitive pressures.
Definitely. Intensifying from AMD, Intel, but also the hyperscalers developing their own custom AI chips. The analysis warns this could lead to market share erosion or pricing pressure down the line if NVIDIA doesn't maintain its lead.
Always looking over their shoulder.
You have to. Then there's macroeconomic uncertainty. AI demand feels secular, strong, but the chip industry is historically cyclical. A major downturn could temper the pace of AI spending, even if the long-term trend is up.
And relying heavily on just a few huge customers.
Right, customer concentration risk. Yeah. Reliance on a small number of hyperscalers means a slowdown from just one or two could have a material impact.
Okay, those are the risks. What about the key opportunities highlighted?
Well, the flip side of demand risk is just continued AI adoption. The analysis sees a massive growth runway still ahead, beyond the current big users.
Blackwell platform's success itself is a huge opportunity, right?
Absolutely. It's positioned as a major technological leap. If it fully delivers, it could drive a substantial upgrade cycle across the industry, significantly expanding their market.
And sovereign AI.
Mentioned again as a key opportunity, a new large-scale demand driver that's really just getting started.
Plus expansion into those other markets.
Exactly. Automotive, robotics, industrial digitalization via Omniverse, healthcare AI. NVIDIA is actively pursuing these, trying to build those next pillars.
What about software?
It's another one. Software and ecosystem monetization. Finding ways to capture more value, maybe recurring revenue, from CU, AI Enterprise, Omniverse, etc., not just the hardware.
And finally, even with the China restrictions, there's an opportunity mention.
Yeah, potential new China strategy. The analysis mentions reports of NVIDIA developing new compliant chips, like a scaled-down Blackwell maybe, designed to meet export rules and maintain some presence there. Shows adaptability, the source notes.
Fascinating. Okay, let's bring it all together. The bottom line takeaways from this analysis for you, the listener.
Okay, first takeaway. NVIDIA is still growing incredibly fast, driven overwhelmingly by that massive global demand for AI infrastructure. Record revenue, $44.1 billion, up 69% year over year. Just huge numbers.
Second takeaway. They took a major specific financial hit this quarter from the U.S. export restrictions to China.
Right, $4.5 billion charge in Q1. Couldn't ship another $2.5 billion, expecting an $8 billion hit to H20 revenue embedded in Q2 guidance. That did impact reported profit.
BUT, and this is the third crucial takeaway. The core business outside that China H20 issue is absolutely booming.
Yeah, the analysis makes that super clear. Revenue beat expectations. The adjusted profit, excluding the charge, was very strong, also beat estimates. It proves demand outside China is incredibly high.
Fourth takeaway, Blackwell is here and ramping fast. Full production, available on major clouds. It's positioned as the next big thing for future growth.
Fifth, gaming showed surprising strength. Record quarter. Shows that foundational market is still healthy and a vital contributor.
And sixth, looking ahead, continued strong growth expected once you adjust for the China impact and guidance. Margin recovery targeted? Key things to watch.
How they manage that China situation. Can they get compliant chips out? And does the overall pace of global AI demand stay this intense? Those are the big questions.
So the core message from this analysis.
NVIDIA remains the clear leader in the AI revolution. Showed remarkable resilience in Q1, powering through a major geopolitical headwind because the underlying demand for their core products is just so strong, plus the successful early launch of Blackwell.
Okay, that wraps up our deep dive into the NVIDIA Q1 FY26 earnings analysis. Really appreciate you walking us through that.
My pleasure. Now, based on the source materials discussion of sovereign AI, nations investing heavily in their own AI. And this push into physical AI, robotics, industrial automation using things like Omniverse and Cosmos, it leaves us with a thought. Beyond the headlines about AI chips for cloud data centers, how will this accelerating global race for national AI capabilities and the development of AI that actually operates in the physical world, how will that fundamentally change the technological, the economic landscape that you live in?
Yeah, that's a big question. Definitely something to think about beyond just the quarterly numbers. A lot to consider there.
For sure.
Well, thanks for joining us for this deep dive. Keep exploring and keep questioning.